Welcome to eOption's webinar, and we're excited to have you here, and thank you for taking the time out of your day to join us. We greatly appreciate it. We're happy to partner with our popular speaker, a professional trader with over 30 years of experience, to bring you this webinar on how to enter and exit basic option trades. My name is Gina Bocayas, and I'm with Regal Securities, which is the parent company of eOption and its sister company, InvestTrade. And to provide some basic logistical information, the session today will last approximately 1 hour. If you have any questions during the webinar presentation, please feel free to type them into the Q&A box on your screen, and our speaker will be happy to answer those at the end of his presentation. We ask that you use the Q&A box and not the chat box, as our speaker may not see if you enter a question in the chat box. And our speaker will be talking for about 40 to 45 minutes, and the remaining time will be to answer your questions. You can access the recording of the webinar in the next week on our website at www.eoption.com, and we'll also be emailing you a copy of the recording in the next week as a courtesy, and you can watch it at your own leisure. You'll also find it on eOption's YouTube channel. We recently revamped the entire channel, and we have all kinds of playlists, no matter what level that you're at. So we encourage you to go to eOption's YouTube channel and subscribe so you can get access to all of our videos. And for those of you just joining, we'd like to welcome you to our webinar on how to enter and exit basic option trades. As eOption's name implies, we are a firm that specializes in option stock trading. Our founder was a founding member of the Chicago Board Options Exchange in the 70s and has been trading stocks and options for nearly 50 years. We charge some of the lowest option rates in the industry, and all stock and ETF trades are commission-free, and options are just 10 cents per contract plus $1.99 per trade. We also offer a powerful trading platform, a mobile app, free trading tools, and live expert support on our trade desk that are happy to answer any question that you have. And something we're very proud of is our excellent customer support, where our professionals are licensed brokers with years of experience, and you can reach out to them with any questions. You're not limited to a trading app where you can't reach a live person to answer your questions. And we also offer a useful options trading tool called Options Play, which scans thousands of stocks each day to highlight potential option trade opportunities for you. Normally that's $500 annually, but it's free for all our customers. And we just did an Options Play webinar a few weeks ago on how to use Options Play and how to get the most out of earnings season. So if you go on our website or on YouTube, you'll be able to see a recording of that and view at your leisure. We also support option education, and we're glad you can join our webinar today to learn more about using options in your overall investment strategy. And now I'd like to turn our attention to our speaker, Teddy Keckstad. Teddy has over 30 years of experience in the financial industry and trading. Some of you may recognize his name from past webinars he's done for eOption, and we're excited to welcome him back today. And just to tell you a little bit about him, he has over 30 years of trading and industry experience. He traded on the Chicago Board Options Exchange, the Chicago Mercantile Exchange, and the Chicago Board of Trade for 21 years. And he's been an institutional market analyst for over 25 years. He currently serves as president of Forex Trading Unlocked, and he is the author of the book, High Probable Japanese Candlestick Patterns. He has a degree in finance from DePaul University in Chicago. So without further ado, we'll turn it over to Teddy Keckstad. Thank you.
Thank you very much, Gina, for that introduction. And I want to thank you all for attending as well today. Real quickly, just want to say hi and hope you're looking forward to this webinar. We just want to show you our disclaimer from eOption real quick to remind you that this webinar is for illustrative and educational purposes only. And since I'm doing the presentation, I always put up my company disclaimer as well, which is basically the same as theirs. Okay, so what you will learn today: how to trade stock and other market movements without large capital allocations, how to expand your portfolio diversification, how to maximize your potential returns with options, basic bullish entry and exit techniques, and basic bearish entry and exit techniques as well. So why stock options? Well, options can help you to diversify your portfolio because you can trade a much broader range of stocks with your allocated capital, especially with some of the pricing at certain stocks that everyone's very aware of. The ability to trade those for most people is, unless you have very deep pockets, is out of the range for most people. But with options, you can actually trade these market movements and have a higher return on your investments. So options allow the smaller to larger investors the ability to capitalize on trending markets that are highly liquid. We are going to discuss 3 of them today that you are most likely very familiar with. Then we're also going to explain to you how trading in these products is similar to trading in normal equities, but with a higher potential return on your investment. So trading options allows bulls and bears to reduce their risk, which that's one of the wonderful things that we're going to highlight, is how you can guarantee one thing for sure, and is what your risk will be. Okay, so today's focus, what to look for. Simplicity is best. What we're going to talk about today is very simple, and how to look for opportunities in the market. We're going to find actionable strike prices. We're going to show you how you can analyze both any equity or underlying asset, and then find very good strike levels to use, whether you are bullish or bearish at the time of when you're looking at this said market. We're going to use some trend-based trades to enhance your odds, and we're going to protect yourself from reversals in the markets as well, with how we highlight how to enter these and find these strike prices. So stocks versus options, we're going to discuss what is the difference between whether you would use the techniques we highlight today or whether you would just go long the stock. So with that, okay, so the parts of what we are going to discuss today. So number 1, we're going to highlight 3 stocks or otherwise underlying assets. You could use ETFs, but we're going to keep it very simple and just use stocks today. The other pieces we're going to discuss today are call options. For those of you that are new or just need a reminder, a call option gives the purchaser the right to buy an asset at a fixed price. In this situation, the asset in question will always be the stock for each model that we discuss. For the put options, it is the right to sell an asset at a fixed price. So it's a way of synthetically going short the market. If the market breaks, you can exercise your option, or you can just sell your option for the increased premium and capitalize on that, which we will discuss as we get into the examples. So the length of time before option expiration, we are going to discuss the expected length of an option trade. We will discuss how you can factor in different possibilities for entering and exiting your trade once especially a target has been reached, and then how to integrate options into your trading plans. Okay, so how do you make and lose money? First of all, that's something everybody wants to know, right? So when you buy a stock or underlying asset and the market goes up, then you profit. It goes up and it appreciates in value, you're up money. When you buy a call, which remember is the right to buy an underlying asset at a particular strike price, meaning point in the market, and the market goes up, then you profit. In this case, the price of the option will go up in value from what you purchased it. And then you'll have the opportunity to either sell out of that option for a profit, or you can hold it on towards expiration to exercise the option to actually purchase said stock or underlying asset. If you buy a put and the market goes down, then you will also profit as well. Remember, when you buy a put, you're synthetically going short. So that's when you're a bear. So when you buy a call, you want the market to go up. When you obviously buy an asset, you want it to go up. But when you buy a put, remember, it's the opposite. You want the underlying asset or market to go down. That's the only way you profit. Now, conversely, when you buy a stock or underlying asset and the market goes down, then you lose value, which means you lose money. The same is also for when you buy a call and the market goes down. So before there is an expiration, there will be some value in the option, but it will definitely go down. The thing with the option is that your risk is totally defined. You can never lose more than what you paid for the option. Doesn't matter when it does expire or whether what happens to the market. Remember that you can only lose what you paid for the price of the option. This also goes for the put. When you buy a put and the market goes up, then you lose money. That's what your risk is also defined once again. So if the market is still moving around and there's time till expiration, it may decrease in value significantly, but it will have some value up until expiration date. So those are the core basics of what we're going to talk about. So let's get into our first example here. So most of you are familiar with the company Walgreens. There's one on many corners in most suburbs and towns in America. The stock symbol, excuse me, is WBA. So let's take a look at why we have this as a model. So I looked at the stock knowing that most people would know about it. So what is the interest and why would you buy the stock and what are the key stats? Well, one thing is Walgreens has always paid a very strong dividend and has been known to maintain its dividends through up and down economic cycles. Currently, they're paying a 3.53% dividend. That's more money than you can obviously get in a savings account, that's for sure. Their yearly revenue continues to grow. However, it does have some interesting variables that are not so positive. The net income is flat. The profit margins are declining. The stock performance over the past one week was down 2 to 2.5%. Now, this is when I first put these slide deck together, which was at the end of April. But these numbers actually still are valid for today for the stock performance. For the month, it was only slightly higher. For 3 months, it was up 9.69%. The market as a whole has been up very strong. 6 months, it was up almost 40%, but year to date, it was up 31%. Now, remember, a year ago, the market was on full tilt, so it wasn't on its highs at that point. But from where we were at the beginning of the onset of the pandemic, it is up 31%. So if you're bullish, buying a call 30 to 45 days out or around that range, maybe even a little bit longer than 45 days, that is your play. If you are bearish, then you would buy a put. So remember this, if you are interested in this stock, but you don't want to buy it and you want to have your biggest return on investment and have your risk defined, then you would be buying a call. If you think that, for instance, since Walgreens income is flat, profit margins are declining, there's other issues, and you think maybe Walgreens is going to fare as well as other stocks are, maybe perhaps in the future 6 to 8 months, 12 months, then you would buy a put to take advantage of that potential sell-off. So let's go and look at how we find our strike prices. So we take a look at the monthly chart and you can see where it says H and you can see where it says L on these different swing points. These H's are your swing highs, these L's are your swing lows. So as you make lower lows and lower highs, it's a bearish trend. So that means no matter what, Walgreens since 2015 has been trending lower into the end of 2020, and now we have 2021 where it has pretty much bounced and stabilized. We're kind of at the average price of the last 2 years. So at the time of this slide deck, the market was trading at 52.60. So to identify if you're bullish and bearish, the best strikes to use in this instance, when you're going for a 30 to say 45, 50 days out, something like that, you would find the upper two strike prices from the current market price, and then the lower two strike prices below the current market price. So to make this a little clearer for you, the strike prices here are the $50 strike price, the $52.50, the $55, and the $57.50 strike prices. They all have a June 18th, 2021 option expiration. Once again, the monthly trend is bearish. So our stock was trading in between the 52.50 and 55 even. So let's go to the next slide to make it a little easier on a daily chart here. So now if you look at this, and let's say that you are looking to buy the stock, it would cost you $52.50 a share. And now for this instance, because we are looking as a short-term investment and comparing options to stocks, we have to make sure that we have risk protected also in our stock. So we're going to use that as our bottom of our range for our strike prices. So the market is trading once again above the 52.50 and the 50 even strike prices, and it's trading below the 55 even and the 57.5. Now, ironically, the last higher move high is just below this 57.5. So should this short-term bull trend continue, you would expect that after having made higher move lows, a higher move high sometime in the near future will arise. If you are bearish and you think that this market is running out of gas and you want to take a counter trend trade, well, that's when you would look to short the market, but we don't want to do that with equities. That's too advanced for most people and most capitalized people, or people that are have the capital to trade in equities. But using the puts, that is the synthetic way to go short. So we're going to look at that after we just get this valuation here. So your upside target, we're going to use this as 57.50. That's our upper strike price target right there. And then we're going to use 50 even as our protection for our stock. So that means that it would cost you $5,200, just a little over $5,200 to purchase this stock and go long. Okay. Now, if you have an upside target of 57.50, that would give you just under $5 of what your potential reward is that you're looking for when you would exit the trade. And your risk would be $255 because that's the $50. So in case the market falls below that, then you take a hit, and that's the amount of money you would lose, which would be $255 there. So now we know our risk defined and our target objective for the stock. Now let's apply an option strategy for that. So instead of putting out the $5,200 to buy the stock, you could trade the options here and buy these call prices of either 52.50, which is pretty much right at the market price, and that would cost $1.90. Now remember, with options you have to multiply times 100, so it's 100, excuse me, times 10. So for this price, you're looking at a very, very cheap price for purchasing your options. So, and now the $50 call, because you have more of a value here, because when you think about options, the strike prices are where you would either have the right to purchase or sell this potential stock. So if you bought the equity, it would cost you $52.55. If you bought the call, you could buy the $52.50 strike price, which would give you the right to either buy that should you exercise it. But in this case, you just want to have it as a cheaper way of getting into the market and having a higher potential return, and also defining your risk. So in this case, we know that should you buy the call at 52.50, looking for a target of 57.50 or a $5 move, that it would cost you $1.90. And we'll get into the pricing of this and what the impact of total cost is on the next slide. If you were to purchase the $50 strike price because you're bullish, it would cost you a little more. It's $3.76. Okay. Now for the put, if you're a bear, the 55, the nearest strike price above where the market is $3.81, and the put is $57.50. So these are the areas, if you're bearish, you would look to buy this put here, the 55 once again, or the 57.50, and you're looking for the market to get down to $50 a share. If you are bullish and you think that this the short-term trend, which is bullish, remember the long-term trend is bearish. If you think that the short-term will continue, then you would be looking to purchase the 52.50 or the $50 calls. One of the reasons you wouldn't want to go below these lower levels of 50 would be because you would have a change in trend. Remember, we looked at the monthly chart and it was trending with lower move highs and lower move lows. That means it's a bear market. Short term on this chart, you can see that it's making higher move highs and higher move lows, and that is a short term bull market. So for the bullish play, we know our target to the upside and our risk to the downside. And then if you're bearish, well, then you're hoping that it does get below $50. So now let's see what this actually means. So if you were to buy the Walgreens stock at 52.50 and use a stop loss at $50, you would know where your upside target is 57.50 and your risk is 255. Now I have an asterisk here. Unlike with options, if you hold the equity, you still have risk over the weekend when the markets are closed. So you never know what happens in world events. You could have the market actually, hypothetically, and it does happen from time to time, open below where your stop loss is, which would mean you would actually, your risk, even though it's defined as long as the market is open, because of that discrepancy, you could potentially lose more on your stock investment than you originally had allotted to. This cannot happen with options, because no matter what, when you purchase options, remember, once again, the only thing you can lose is what you purchased and paid for that. So now let's see what this works out to. So your risk reward, if you were to buy the stock, basically was $2.55 for a potential of $4.55 plus a potential dividend. Now, in this example, I don't believe Walgreens was in the process of paying a dividend, but if you're holding a stock during such a trade, or as an investment, if they pay a dividend, even when the stock is going down, you will be getting that as either a cash payment or a dividend reinvestment as shares of stock. So that would be something that could potentially add to your potential reward, and also reduces your potential risk, but only by a slight margin. It's a very small percentage. Remember, their dividend rate was 3-point-something% annually. So now if you were to buy the call at the 52.50 call for $1.90, your upside target is 57.50. Okay, so your risk reward on this would be $1.90 or $190 versus a potential reward of $5 or $500. Plus, there's a time premium left until expiration. So if, for instance, the market rallies up to 57.50 today, while the market is still trading, actually right now it's currently trading at 53.40. So Walgreens is only slightly higher than it was when I first put this slide deck together. So in that case, right now, let's say that the market did rally above 57.50. You would have that premium that's all there because of the difference in strike prices. You're now above 57.50, and there would also be a little bit of time premium left because there's still time before expiration. Remember, we're looking at the July 18th, which still gives us a little over a month towards expiration. So there's time premium involved here. And just to give you an idea, the 52.50 call, which if you would have purchased it back then for $1.90, it's valued at $2.33. So it's up slightly, but not very much. You're only looking at 43 cents, or in other words, $43 per option, which now remember, that's because the stock price when we did the slide deck was 52.55, and now it's almost $1 higher. So those calls are worth a little bit more, but the puts, even though they've fallen down in value because there's still a month left, they haven't fallen by so much. And we'll get to that in a second. So if you were to buy the $50 call for $3.76, that's your risk, and your upside target would be 57.50. Now in this one, because you have the lower strike price, your risk reward is different. You have a risk of $3.76, which is your initial price of the option, or $376, but you have the potential to make $7.50 or $750. So in this case, where you could only make $5 before at that same target, you're looking to make $750. It's an extra $250 per option, because that's the difference between those strike prices. Okay, plus there's also a time premium that would also still be of value should the market be above those levels. And this market here, because it's slightly higher, this was 376 at the time of the slide being created, and now as the market's trading at 395. So the calls, once again, would be up a little bit of a profit, just like the stock would be had you bought the equity. Now, as far as the puts, the $55 put, which was at 381 with a downside target of $50. The risk reward, once again, was the $3.81 that you would have paid for the option. And then the reward you would be looking for would be the $5 move from where it was at, plus the time premium left until expiration. So remember, that's where you want the market to go down, and that would be below that $50 level once again. Now, if you were to buy the $57.50 put, which is the next strike price higher, you would have a risk of $5.75, and your downside target would be 50 cents. So in this case, you would be risking $5.75 or 575 to make $7.50 plus whatever time premium is left, or $750. Remember that there is a value for every option because there is time. As each day goes by, that time value decays no matter what. So whenever you buy an option, remember, time works against you. It does not work for you. It always is eroding from the very second that you buy it. Okay, so now let's go on to our next example. We have Caterpillar Inc. So for those of you that aren't familiar with Caterpillar, those are some of the tractors you see along the highway doing all kinds of construction and what have you, and work along the interstate and stuff. So let's see the stats for buying the stocks that are key. The dividend yield is less than the last one. It's only 1.79%, but still beating that of a savings account or in most CDs. The yearly revenue is dropping year over year. This is not good news and not good for the stock should you want to purchase it or be thinking about buying it. The net income is also decreasing recently over the past few years. That is also a negative thing for the stock. So right now we have some bearish winds blowing as far as Caterpillar Inc. is concerned. The profit margins are declining as well. That's another negative thing. It's one thing when you have revenue and income decreasing, but if your margins are also declining, that's a triple whammy. So as far as buying this stock, doesn't look so hot, does it? It does pay a dividend, but it doesn't look very strong. Stock performance here was very mediocre over the past week. The past month when the slide was created was actually 2.71%. These things are actually not bad, but that's probably because the overall market is strong. The 3-month gave 22%, but look at this. The year to date is only 26%. And that's when the market was at a very, very low point when the beginning of the pandemic was starting to impact the equity markets. So for this stock to be only up 26% over the year, which is barely matching the 3-month, or just superseding the 3-month, that's not very, very good at all. Especially when you see the 6-month is at 35.7%. So it's very interesting to see how this has been swinging. Doesn't seem to be very positive as far as being an equity investment, unless you were just looking for a long-term dividend payer. However, to increase your ROI, trading with calls and definitely puts, if you are bearish this market, is the opportunity. So once again, we're going to look at calls and puts that are 30 to 45 days out. Okay, Caterpillar monthly, look at that. It's exploding like a balloon underwater. Looks really bullish. It's amazing with all those fundamentals that look so bad. The overall trend, here's a low back here in 2016, 15-ish. We had this high up here. We made a higher move low, and we have definitely taken out the highs to make higher move highs over the past couple months, with it starting to run out of gas. So the short-term trend is explosive. The long-term trend is positive, even though the fundamentals are negative. So all kinds of reasons to be a bull and a bear. Once again, we're looking at the June 18th, 2021 expiration. The strike prices we're going to look at, since this is currently trading at 230.39, for our example, we're going to use the strike prices of 220, 230, and 240. And let's see how this pans out. So once again, we have kind of a breakout area above the recent highs here at 237.90. So that's our 240 strike price barrier. And then 220 here is just above this last higher move low, which is at 215. So 215 is really where we're looking for if you're bearish, for the market to get down to, but that would be below our 220 puts strike price here, which would be good for if we have puts on. So what we're going to look at here is if you were to buy the stock. Now this is where options comes into play for most individuals and even high net worth traders. If you were to buy the stock, it's at $230.75. So that's over $23,000 to buy 100 shares. In this case, if you were to buy the options, they're expensive as well. But 1480, it means, for instance, if you were to buy, or excuse me, the call here, let's say you were going to buy 230 is the stock equity price. Okay, so that'd be $23,000 to purchase that. This 230 call here, which is 988, would just be $988 to purchase. So for under $1,000, you would control that stock until the option expiration of June 18th. So if you were bullish, and you, especially in this situation where you know the fundamentals are very bearish, you might be more inclined to use calls and buy the stock. And if you're bearish, where you think this market is overdone because the technicals don't match the fundamentals, then these puts might be attractive to you. So even though they're expensive, trading these options is nothing remotely as expensive as purchasing the stock. And here's the other thing too, is think about this. For these parameters that we're using for these strike prices, like we're using this 215 as our downside target if you're a bear, and we're looking at this 237 target here if you are, excuse me, 240 target if you are a bull. Your risk for the stock is $14.76 per share. So basically, that would be, what is it, $1,400 just on the stock alone, which remember, you have weekend risk, which you do not have that kind of exposure with options. So for instance, let's say you were long the stock and it settled on a Friday at $220. It could open the following Monday at $200, and you would go through your stop loss. You wouldn't be getting out at 215, you know, right here, which is where you would have your protection while the market is actively open. But like I said, if it closes and then there is that kind of movement, then that can go through that stock price. Normally it couldn't go through it. If it did, and while the markets are open, then that means it just trades through it a little bit because of liquidity and the amount of volume at that price level. So you wouldn't gap through that. And that's the kind of thing, that kind of exposure is something that you have to take into account if you're purchasing the outright equity stock. Okay, with the options, remember, once again, these prices here times 100, that is your risk. So your 240 put would be 1,480, your 230 put would be 855, your 230 call would be 988, and your 220 call would be 1,689. And those would be giving you the right to either buy 220 or 230 or sell 230 or 240. So let's go through this in a little bit more of a easier way to read it. So if you were to buy the Caterpillar stock, once again at 230.75 with a stop loss of 215.99 with an upside target of 240, your risk would be $14.76. And that would be to basically make less than, actually you would be risking more than your potential target is. Now, of course, you could hold on to the stock if it rallied through your initial target, and then lift your stops and put it to a break even or somewhat profitable stop on your stock, if you will. But these are all things that you have to, hopefully it does occur. With the options, you don't have to worry about these things because your risk is defined, and also so is your time frame as well. So your risk reward here on this one was 1476 to 925 plus any potential dividend. Not a very good thing to take right here. This alone right here, if this is what you were looking to do, you would say, no, I will not buy this equity, because why would you risk more than you could potentially make? So but that doesn't mean you can't trade Caterpillar. That's what options are for. So if you, oops, sorry about that. So if you buy the 230 call for 988, you know that's your risk. Your upside target is 240. Your risk reward here is almost 1-to-1. It's 988 to 10 plus the time premium. So here you would have some potential reward on this option right here. If you buy the 220 call for 1689, same upside target, then you have a little bit more risk, reward to your risk, where you'd be at 1689 for your risk and $20 plus time premium for your reward. there's a little more incentive if you're bullish to purchase those calls right there, just because there's more reward to your risk. And that's what you always want to try and do. If you were to buy the 230 put because you're bearish because of the fundamentals and you think the technicals are overdone, then you could purchase the 230 put, which is pretty much at the market. And by the way, Caterpillar is actually higher right now, so you would be losing money on this one. The downside target of 220, or a little bit beyond that, whatever, because we had 215, I believe, was the target. So your risk reward here would be risking $8.55 or $8.55 to make $10 or 10,000, or excuse me, 1,000. Plus your time premium as far as the value of your option. And remember, once you get to a point where you hit your targets, that's when you exit your options. Or you can hold them if you think that they're going to, if the targets are going to continue, the trend will continue in your favor. But remember, the time always ticks against you. So once you already hit your profit objective and your profit target, that is one of the best times to exit your trade, because at that point, you know that one, you've hit your mark. If the market doesn't move at all, you can only reduce your potential reward because time ticks down against you. So in this one, we have the 240 put, which would have given you a little bit more risk for the same target, where you would have 1480 with the potential of 20 plus your time premium for expiration. So this one would give you a little more value. And once again, this currently, the market is trading at 239, so it's up $10. So even though the fundamentals are bad, this is definitely a play that, you know, obviously the trend is your friend, the bulls are there. So the calls right now, for instance, the 230 call, which was at 988, is now 1473. That would be profitable. The 220 call, which was at 1689, is at 22. So they're basically up $500 to $600 or $6 in this case per option, with the puts being basically down about the same as well. But remember, in this case, because of the option expiration in June 18th, you still have a little over a month, and anything can happen with the market. So these pricing and whether the calls or puts are profitable is yet to be determined, depending on how long you would stay in the trade. So now let's look at Coca-Cola, something that everyone is familiar with. The buying the stock key stats. Now this one has a decent dividend yield of 3.08%. Coke has always been a steady revenue payer for our dividend payer for decades. But interestingly enough, with the pandemic going on and what have you, maybe that's one of the reasons their yearly revenue is down as of late over the past couple of years. Their net income is also down over the past couple of years. Their profit margins are declining. This is sounding a lot like the first thing we had with Walgreens. So another tried and true dividend paying stock isn't looking so good. The stock performance at the time of the slide deck was just down about 0.39%. with a 1-month performance of just over 3%, which was good, especially in lieu of the bull market that we've been in. The 3-month is up 10%, but this is where it gets really shaky. If you look at the 6-month performance of Coca-Cola, it's only up 6.14%, with a year-to-date of being down 1.91%. So that means that we're lower now than when the pandemic first hit. So in this situation, the fundamentals are looking very bearish. Now, if you're looking for the dividend rate and you like the stock, obviously investing in the equity is what you would do. But if you are bullish, thinking that, as we come out of the pandemic and there's all these opening up of the states and businesses, and also the big thing is you have the big venues, the athletic venues and entertainment venues where you have all this vending, where you'll have Coca-Cola being sold in, abundance once again through the use, because they haven't sold any syrup. They've been selling nothing but bottles and cans and 2 liters, and instead of selling syrup to all the venues. So that's probably when, if you're bullish, you would be saying, hey, you know what? I don't care what the fundamentals and the technicals are doing. I like Coca-Cola. I think they're a bull. Let's see what happens. So actually right now, as we're speaking, Coca-Cola is slightly higher than the $53.78 it was at when we did this slide. Now, interestingly enough, if you look at the trend here, it had been making higher move highs and higher move lows, higher move high, higher move low, all the way up until the beginning of end of 2019. pandemic happened, obviously it slammed and made a big low. So between the higher move high and lower move low, that shocked the stock into neutrality, if you will. Short run, this market's been making higher swing highs, higher swing lows. It is bullish in the short run as far as technically. Remember, all the fundamentals were bearish. So this is a monthly chart. We're looking at this, the June 18 expiration once again. And since the market is at 53.78, we're looking at the $50 call, the $52.50 call, the $55 call, or strike prices, excuse me, and the $57.50 strike prices. Ironically, these are the same strike prices as Walgreens. They're different equities, just the same dollar pricing strikes. Just happens to be that these markets are trading at the same level right now. Okay, Coca-Cola daily. Let's see what's going on here. Now, this is where the bulls come into action here. As the trend is always your friend, you have higher swing high, higher swing low, higher swing high, etc., trending higher. So we're looking, as the way things go, after this higher swing high, from the market to hold and maybe make a higher swing low or continue to make a higher move high. So if you're bullish, now it's a little harder to see on this one than the other one because it's stretched under the highs here, but we have the 57.50 as our strike price, 55 strike. Also, these would be our puts because they're above the current market price of 53.78, or at the time of the slide, excuse me. The 52.50 and the $50 also call. These are the strike prices to the downside. So now if you were to buy the stock at the time of the slide deck, 53.78 would have been the price per share, or 53, basically a little over $5,378. The stop that we would be using here, because of the fact that this market's this has been trending higher, we would keep the stop and the risk at this one right below the strike price here, which would be 52.27. So our 52.50 call would be basically our base of bullishness, and which, remember, we were taking the first strikes above and below where the market's trading. And this just happens to be just above the swing low. So we know that if it gets below this one here, it's probably going to stay in neutral or be a short-term bear, which means that do we have enough time to be long with the call? Maybe not. Maybe the puts are the way to go. Or you can look at it, the 52.50, because it's cheaper. If the market really is a bull, it should not get below here. And then it should make a stay either flat or go higher, meaning your risk would be very defined and you have a high risk or high reward to potential risk, what you have going on. Or you could do the $50 call, but remember, because this market's been trending higher, you may not really want to use that $50 call, because that means the market's correcting and you're going to have to wait for it to come down and then swing all the way up to get that to your upside target. So if you're bullish, probably the 52.50 is the right call here. And if you're bearish, then the 55 or the 57 are good. I would say the 55 is the correct one because this was a recent swing high. So sometime between when the slide was made and now, or what have you, a new swing low will have occurred, which actually it has. Coca-Cola actually is slightly higher at $54.30. So it's still right in the middle of this range. So let's see what that equates to for you. So with this, if you were to buy the Coca-Cola once again at 53.78 with a stop loss of 52.27, your upside target was 57.5 with a risk of 151. Remember, there's always your weekend risk, which could mean that your stop could be traded through in case if the market moves adversely against you between Friday afternoon and Monday morning. The risk reward is $1.51 for a potential of 372. So a 372 reward to risk ratio plus dividend. That for a potential dividend, that's not such a bad trade. So if you're buying the stock and the equity, Coca-Cola is a solid company. Even though it has some deteriorating fundamentals, I don't think Coca-Cola is going out of business anytime soon, and it does still pay a strong dividend. So now if you buy the 52.50 call, remember that's the one I like because it's above that recent higher swing low. Your call would cost $2. Okay, or $200 with an upside target of 57.50. So there you have a reward of $5 to $2. So that's more than 2.5 to 1, plus your potential time premium left on your option. That's pretty good. That's a very nice risk reward. So if you're bullish, the 52.50 which currently at the time of this writing, let's see, the 5250 cost, what was it, $2? Now it costs $2.39. Well, the market's only 50 cents higher. So that option would still be worth more than what you would have paid for it. The $50 even, the $50 strike price call cost $4.05 at the time. That one right now cost $4.50. So that one would also be up a little bit more. But in this case, you would be risking, or the reward was $7.50 versus the $4.05. Obviously, there's the time premium that's plus that. So this one is not on a reward to risk basis, besides the fact that it goes against our trend potential outcome that we discussed, as far as it being bearish and not being able to come to fruition as being a profitable option. Your reward is less also on this one, based off of your risk. So once again, that 5250 call, that's definitely the one to look at in that kind of a situation. And if you were bearish, obviously, because the stock is slightly higher, the options are worth a little bit less. But let's review what the risk reward was on this one. So for the put, and remember, there's still time on this trade, your downside target was 50 even, which is just above that one, or below that one swing low. Your risk reward on this one would be $5 to $2.33. So your $55 put basically gives you the same reward to risk ratio, just a little bit less than your call would be at the 52.50 level, remember, plus your time premium, obviously. And also the same, now the higher output at 57.50, that would be 365 of risk, same downside target. This one gives you more of a 2-to-1, or a little less than 2-to-1. As far as reward to risk, and plus your time premium, obviously, as well. So not quite as much bang for your buck, however, since this isn't a bullish market, remember, like how I said, that one swing low was the reason you want to use the 5250 call, as far as being long, if you're going to buy the option. The 55 even put is really good as far as being short, because if the market gets above 55 even, then it's basically saying that after having made a higher swing high and a higher swing low, it's going to make a higher swing high. Remember, this would be a counter trend trade, being short into this rally right now, or being synthetically short through the options. Okay, so with that, I just want to remind you once again how you can maximize your option trading potential through the use of eOption and options for your stock ETF and ETF option trading. Remember, they have their free option strategy tools like Options Play. They have the free option strategy guidebook also at eoption.com. They have a free paper trading account to test your strategies. So you could test buying calls and puts in examples like this, where you identify a trend, you identify some support risk areas and target areas, and then you put those trades on in the simulator and see how they would perform. And remember, once again, that ETF and stock trades are all commission free, and option contract commissions are only 10 cents per contract. So real quick, let's go over some questions here. Let's see, we have Rosita. Why would you buy a $50 call? It's more expensive. Yes, well, that one, the $50 call, yes, it is more expensive. However, the $50 call gives you more room as far as, remember, the other price was $52.50. So let's say that the before expiration, or near right before expiration, that the market really hasn't gone very far and it's fallen below $52.50. Had you had the $52.50 call, it would be worthless going into expiration. Whereas the $50 call would still have some premium because of the difference between the $50 strike and the market price. Like, let's say the market was at $52, you would still have $2 of premium because of the option before expiration. So you could get out and still have some of your money back on the $50 call. Whereas with the the $52.50 strike price call, you would not have anything left of value. So you would just let them expire worthless. So in that case, so I don't know, I think that should answer that question. I don't know if we have any more. Oh yeah, here we have, let's see, there might be some questions about the strike prices once again. So remember, when you're looking at these equities or underlying asset, you find your current market price. And then what you want to do is find your nearest strike prices above the current market price, 2 of them, one, obviously the closest, and then the next furthest away. And then you want to find the ones below it that are closest to it, and then the next closest below that one. Those set your parameters for calls and puts as far as if you are bullish and bearish as which strike prices to use. Now, then you also overlay your trend analysis. So for instance, if you know the monthly trend is bullish and the daily trend is bullish, if the market has been correcting, and then you're assuming that, or you're assuming that the trend is going to remain. And if it does, because there's no reason to think a trend won't remain doing what it does, then you would be looking for a swing low to occur. So you'd be looking for calls to buy. The conversely would be if you were in a bearish trend and you had the market had been rallying, you'd be looking for a reason to put on some puts. And the good thing is for your swing lows and your swing highs, you can use that as your risk levels. So for instance, when your stock is going up, your last swing low or one of your recent swing lows would be potentially your risk for if you were just getting into the market and getting long, or you would use that for your strike prices above that for your calls. And you know that if, for instance, like the market's at 55 and you have a 52.50 call on and the last swing low was $49, if you had the $50 or the 52.50 call, you know that those would be your numbers, because if the market falls below that 49, that you're looking for a lower swing low, which means you're on the wrong side of the market if you're buying the stock for sure. And if you're buying the calls, you want to have the highest risk reward. So you don't want to pay up for options that are just decaying when you could pay a very reduced price if the trend is your friend and it's maintained. Otherwise, you would buy the put if you're really looking for the break, and then you would risk the recent high, which would be in that case like the 55 even strike price. So let's see, can someone exercise the right to buy a call before the expiration date? Well, you wouldn't need to, because you have the value in the option. So, but yeah, you can exercise your options at expiration. But beforehand, the pricing of the option, like you wouldn't do it because of the cost. There's really no reason, because you're making your money unless you really want to hold the stock, in which case you could do that. Let's see, would you be able to break down exiting an option strategy like a bull debit spread? A bull debit spread would be something I'd have to explain for everybody I mean, yes, I could break that down for you, but without visually having a couple numbers and something to draw on, I don't think most people would catch on to that really quickly. So, but once again, for exiting in the trades that we discussed, what it would be if the equity or underlying asset hits its target in the instance of whether it's bullish or bearish, that would be when you would want to sell out the options that you had. Okay, because remember, when you're using options, you're getting the synthetic value. So instead of owning the stock, like for instance, you could exercise the stock. And the reason I'm hesitant on saying, would you do it before expiration? The whole thing is that if you would do it before expiration, you're buying, you got to remember, you still have to pay for it, so for me to say, would you do it? It depends on how much capital you have in your account and whether it's the right thing to do from that kind of a thing. I don't want to say that you would exercise a stock just because the market is above a call price. So especially I would never say somebody, if they bought a put, to exercise a put and be short a stock, because then you're dealing with margin, which totally changes the initial vehicle that you're using. Remember that when you're buying options, it's the right to do something. It doesn't mean that you necessarily do it. You get the value in the pricing of the option itself, and it's cheaper to just take the profit through the selling of the option, exiting it that way, especially if once you've hit your profit target, or if it's exceeded your profit target in any given day, and you still have time left. Like right now, for instance, there's a month left on the options examples we were talking about. If you were to exit them now, there's a time premium that's there too. So if the market had rallied, like in the case of Caterpillar, where your calls are up money, you're up $500-600. If you think, especially now that the market's making a little sell-off and maybe that things are going to turn down into the springtime, you're up a little money. Yeah, I would definitely sell the calls and get out of it. And especially if you had the stock, I would do the same too, especially with the underlying fundamentals. Let's see, we have another question. Would you be able to break down exiting? Okay, that's another one for another type of spread. Okay, well, with that, I want to move on since we got most of the questions answered. And oh, you're welcome also for you who are just put that thank you in. So just to remind you, if you want to learn about when to actually put on some calls and puts and have a reason to do it in your equity markets, read the book High Probable Japanese Candlestick Patterns, available on Amazon.com, available in paperback and Kindle versions. It's written by yours truly, Teddy Keckstedt. And also like and subscribe to our YouTube channel at Forex Trading Unlocked, where you can catch other videos and lessons that we have on there. And then also for more eOption resources for you, remember to go to www.eoption.com for more option trading resources like the ones we discussed and that Gina discussed at the beginning of the video. And also to watch more videos in options trading, subscribe to the eOption.com YouTube channel, eOption. Check it out and become a subscriber. And with that, I'm going to turn it over to Gina.
Great. Thank you, Teddy. That was very interesting and informative. And thanks so much. And thank you to all of our attendees for taking the time out of your busy day. We greatly appreciate it. And if you want to trade some of these option strategies that Teddy talked about, don't forget to take advantage of eOption's low rates. All stock and ETF trades are just zero commission, and options are just 10 cents per contract plus $1.99 per trade. And if you're not ready to open an account at eOption, we encourage you to try a paper trading account. You get 100,000 in virtual currency, and you can try some of your option trading strategies there, and that would be risk-free, and try our trading platform. So we encourage you to check that out. And at eOption, you can trade on your desktop, your laptop, or we have an app on your phone. There are many ways to trade with us. And we also offer you free tools like Options Play, as I mentioned at the beginning of the presentation. So that's normally $500 annually, but we give it to you free if you're a customer. And that basically scans thousands of stocks each day to highlight potential option trade opportunities. And as I mentioned, we will have a video recording of this available later in the week. You can go to eoption.com and get it, or you can also see it at our YouTube channel, and we will be emailing it to each person who has attended this webinar as a courtesy. And I know in the questions, a few people had questions about spreads, like a bull debit spread. We encourage you to go to eoption.com. We do have clickable links, strategy links, so you can type in whatever spread you'd like, and it'll go through the strategy, the motivation, and have videos for you. And so we encourage you to go to our strategy links on our website to learn more if Teddy wasn't able to address it in his Q&A session. And also we encourage you to give our trade desk a call. We're always happy to answer your questions. And again, that's one of the factors that differentiates eOption, is that we have a live expert support desk. The average person has over 10 years of experience, and they can answer any questions about a strategy, about the trading platform, about Options Play. So we encourage you to give them a call, or we also, you can email or reach out on our website, and we're happy to work with you and answer any questions. Again, as Teddy mentioned, our YouTube channel has lots of videos as well, so we encourage you to subscribe. And we have all kinds of playlists. We have it on spreads, Options 101, Options Play, our free trading tool, earnings season. So whatever you're interested in options, we probably have a playlist on it for you. And last, if you could just take a look at the screen, we do have our next webinar on June 10th in a couple of weeks. That will be given by the Option Industry Council. And those are very popular. And this one is on income generating option strategies. So we hope you'll be able to join us. That's on June 10th at 1 p.m. Central Time. And you can register at www.eoption.com/webinars. So thank you again for your time. We really appreciate it. And we know your time is valuable. So thank you and be safe. And we hope to see you at the next webinar on June 10th. Bye now.